Okay, spending the time on that. So let's really talk about hydrocarbon tax. Okay, hydrocarbon tax is one of the very important topic in your syllabus, as this was introduced by the Act in 2021, and ICAN have been testing it for some time now. ICAN have been testing it, and when you look at the pattern, it's not clear, Alaja. When you look at the pattern the exam usually follow, you will notice that hydrocarbon tax or Petroleum Industry Act question is usually question number 2, or in section 2, question number 2 or 3 at times. So that is how the examiner usually tests this question. And it is therefore important that everybody that will be in this class have a full understanding of this topic, because it is going to be helpful and useful for every one of us in this class for this exam purpose. Now, for this purpose, I'm going to be looking at the objective of the Act, objective of the Petroleum Industry Act, and number 1 of the objective is to promote exploration and exploitation of petroleum resources in Nigeria. Alaja, your screen is not clear. You can't use this screen. Can someone else share? Alaja, stop sharing. Let someone else share. So number 1 is to promote the exploration and exploitation of petroleum resources in Nigeria for the benefit of all Nigerians. Number 2, to promote efficient and effective use, to promote efficient and effective and sustainable development of petroleum industry. Again, to promote transparency, to promote a liberation of downstream petroleum industry. These are the few objectives. Good. Thank you. So these are the few objectives of the Act. Okay, so the Act is deliberate in ensuring that transparency will be in place, and at the same time talks more about downstream industry. Okay, move on to the next one. Now, what is very important is that the Act clearly distinguishes the administration of upstream and midstream and downstream operations. Now, the Act provides that the Commission is going to be responsible for the administration of upstream sector. Commission, NUPRC now. Nigeria Upstream Petroleum Regulatory Commission will be responsible for the administration of the upstream. Meanwhile, for the downstream sector, what is going to be taking charge of that is the authority. So we're not going to be discussing too much about, but let's go to administration of operations. We have 3 types of license that we're going to be looking at. The first license is petroleum exploration license. Now, this gives you an exploration right just to explore. You don't own it, you just want to explore.
Now, please, your voice is cracking.
So
Sorry, sir. Your voice is not clear.
Sir, please, your voice is cracking.
So let me, yeah, thank you. Can you hear me clearly?
Yes. Yes, sir.
Okay.
Yes, sir.
All right, thank you. So as I was saying, you have three types of licenses here that an upstream company must obtain. The first one is exploration license. Exploration license. This does give you right to explore. Not only resources you find there, you're just exploring. Okay, so that's the right that this gives you as a company. The next one is petroleum prospecting license. Now, this gives you rights to explore, to drill, and appraise your well, do tests, but you still do not own the exclusive right to the asset. Okay, so you can do all sorts, but you still do not own right to the assets. But for petroleum mining license, now before you get to this license, you would have done the prospecting license, right? Now from the prospecting license, then you now move to mining. Now for mining, it gives the applicant the right to win and dispose of crude oil. This first one just gives you right to drill. But this one gives you right to drill, right to explore crude oil, right to dispose the crude oil. And it has a maximum period, which is 20 years for you to do that. So that is that. So these three licenses are very important in the upstream sector. We'll move on to the next one. Move to the next page. Just like I've told you the other time, that the commission is responsible. When I say commissioner, I mean PLC. Okay, so he's responsible for granting the petroleum exploration license. Okay, the commission shall have the sole right and title over the acquired raw and interpreted data obtained by the licensee. So that means the first, the exploration license will be granted by the commission. Meanwhile, this prospecting license and the mining license will be granted by the Minister of Petroleum. Now, book of accounts by leasing. You don't need all this. Move to the next page. Now, move to the next page. You can just read all this. Now, because government attention is going through gas infrastructure development, I think this part is very important for you to know. Now, Midstream and Downstream Gas Infrastructure Fund. Now, my question to you will be, what will be the tax incentives that a company that goes into gas will get? I'm going to be discussing that with you in a separate class. Let's move on. Scroll up. Now, for the purpose of upstream business, upstream business is not the same thing as downstream business. Okay? For downstream business, there are a lot of things that are involved in downstream and midstream business. Midstream is more of gas. Downstream is more of disposal of petroleum products. That is the finished products, right? Now, if that is the case, when you're not talking about downstream operation, we know that that has to do with marketing and distribution of petroleum products. Okay, but when it comes to midstream, it talks about gas, disposal of gas, transmission of gas through pipeline, and so on. Now, if you live on the Lekki Ibeju axis, you notice that government is laying down some pipes. Jakonde, you see all those pipes. They are burying them. So what I'm thinking is that that is going to be a pipeline for gas, which government is already laying the foundation. So that is that. But meanwhile, for upstream business is not the same thing as downstream business. For upstream business, this has to do with winning and disposal of raw materials, raw crude or crude oil. Okay, so we are talking about exploration, exploitation, drilling, producing, and development of well as disposal of chargeable oil. Okay, as well as what? Disposal of chargeable oil. That is what we call upstream business. And for the purpose of our class, we are going to be focusing more on the upstream taxation, right? So let's move to fiscal aspects of Nigerian tax. So let's move to the next page. Move. But before we go, let's talk about host community development trust funds. Go back. Go back. A page before this. Good. Yes. Now, one of the things that is okay, is okay. One of the things that hydrocarbon or petroleum industry has introduced was the establishment of host community development trust fund. Now, when you talk about host community development trust fund, this trust fund was established for the purpose of ensuring that the community in which crude oil is being lifted, they are well taken care of by the companies. Because most of the time, these companies usually complain that their needs are not being met. Therefore, the Act now provides that for host community, 3% of their operating costs for the prior period must be made available for the community and pay into a fund that will be established by the community. So when I talk about host community development trust fund, I am saying that the 3% of that, of the expenses, operating expenses of the company, will be made available for the company to be sent to the, by the company to be sent to the host community account on an annual basis. So imagine your operating expenses is 100 million in a year, in let's say 2023. So for 2025, for 2024 rather, when you're making your payments, you are calculating 3% of 2023 OPEX. 3% of 2023 OPEX as your host community development trust fund. So if examiner really want to test this is what they will do. They will give you host community, they will give you prior year OPEX. Prior year OPEX. And in the financial statements, they will put the OPEX paid by the company in that year. So imagine 100 million was the OPEX of the company. 3% of 100 million is 3 million, right? Let us now assume that the company had paid 5 million into the host community development fund. The law says 3%. You have paid 5%. The 2% will be disallowed. That means in your prior year, 100 million was your expenses. You are supposed to calculate 3% of your 100 million, which will be what? 3 million.
Hello, sir.
But, yes.
Sir, sorry, sir. I just observed that I love that your board that used to share. Compares as if I'm reading and also listening at the same time. So I would love maybe your board better while we read this later, sir.
Okay, I should use my board instead of this.
It gives me more understanding than
Yes,
looking at it. Yes, sir.
okay. I'll stop sharing. Let me use my board, please. Thank you. Can you see my board? Can you see my board?
Yes, sir.
You like the board? Simple. I was talking about host community development trust.
Sorry, I'm not seeing anything. I don't know, maybe it's mine or something.
What is that?
I think the board is still.
I can
That's,
see it.
You
you
sure?
can see it.
Alright, I can see it now. Thank you.
Who is that?
Is IJ?
Hi, Jay. Hello. How are
Thank
you?
you.
Jennifer. How is Jennifer, your friend?
She's fine. She's doing okay.
Okay. All right, let's go ahead.
Mm.
So, as I
Sorry.
was saying, so I said the Act provides that all petroleum company must provide 3% of their prior year operating expenses. Must pay. All petroleum companies must pay 3% of their prior 3% of their prior year operating expenses to a dedicated fund called Host Community Development Trust Fund every year. Okay. So, for example, I now said, take for example, in the question, the examiner gave you OPEX for prior year, 100 million. In the income statement that you are provided, the company paid 5 million, right? So we are saying that the 5 million paid by the company is not an allowable deduction. The maximum you can deduct is 3% of 100 million. 3% of 100 million. By 100 million, that will be 3 million. So if you are using the adjusted if you are using the adjusted approach, you would add that 2 million. But if you are using the turnover approach, you will only take the 3 million. Okay? So let me say that again. If you are using the turnover approach, you will only take the allowable portion. If you are using the net profit approach, you will disallow the 2 million. So what we are trying to say here is that all companies must pay this to the host community. Now, the Nigerian Delta people, they are very nice people. So you don't disturb, provided you do all these things for them. Now, but if, for example, this fund that we made this fund, mute your mic. All these people that are just talking without their minds, mute your mic. So these payments will only be made. You have not sabotaged the production process. If you have not sabotaged production process, that's not everything. If you have not disrupted the activity of the company. And the last one there is there must be peace in the environment. Now, in case the company's pipeline, in case the company's activities are disrupted, what would happen? The 3% shall not be given to the community in that year. Because what would happen? It will now mean that the company will now need to spend that 3% to fix what has been damaged by the community. So it is now left for the community to ensure that they protect the company's assets. It is a win-win. The community is winning, the oil company is winning. Now, to me, I would have said this is an overkill. And why did I say so? Before now, we have NDDC. Abi, which is supposed to serve the same objective. But a claim is now that NDDC is for the region. Meanwhile, ND is also 3% of the company's budget. 3% of the company's budget. Percent of the company's budget. So why then introducing this one, which is 3% of the OPEX of prior year? So why then introducing this? So the main purpose of introducing this is community specific. So in the community where I operate, I must take care of the community people. Do you understand me? I don't need to extend beyond my community with this. So if I have a pipeline that runs through your community, I don't want you to sabotage my pipeline. I take care of your traditional rulers. I give your youth scholarship and some other things. That was in the past. In the current administration, is that this 3% should cater for all this. Okay. Now, having said this, I move on to the fiscal aspects.
Sir, please, sorry, I don't want to take us off. Please, can you just explain the difference between the NDDC and the 3% for community, please? I didn't get that clearly, sir.
No problem. So for NDDC, is region specific, while Host Community Development Fund is community specific, right? That's number one. Number two.
Thank you, sir.
Number two is that NDDC is 3% of the company's budget. 3% of the company's budget. Meanwhile, for Host Community Development Trust Fund, is 3% of the company's OPEX of prior year. So if we are in 2024, right, the host community fee that we're going to pay in 2024 will be 3% of 2023. Do you understand this? Do you understand that?
Yes, I get it now, sir. Thank you very much.
So we are moving straight to what is our concern in this syllabus.
Sir, sorry, I have a question. So
Okay.
this 3% that the company is paying from of their OPEX, in this example you gave now, the 100 million was their revenue. Then
No. expenses.
Expenses. Okay.
Yeah.
So I was not like confused that since the company is paying 3 million to like 3% to government, is it that like the government will, when they sabotage something, the government will tell them not to pay the 3 million to them, but to use it and fix the whatever they sabotaged?
The company will not pay because that's part of the law. It's not the government will
Oh,
tell them. The company will not just pay.
okay.
Yeah. So, and this host community development trust fund is not paid to the government. It's paid to the host community trust fund of that community. So the expectation is that the community would open an account. Okay. When they open an account, in conjunction with the representative from the oil company. So a representative from the host community will be part of the board. Representative from the company will also be part of the board. And this fund will go into the fund established by this community, right? So that's that. So for the fiscal aspect of this act, we are going to focus more on the upstream. I'm focusing more on the upstream. Now, when I say upstream activity, upstream activities include the exploration, development of the well, as well as this is not writing. I said upstream activities include the exploration, the exploitation, drilling of appraisal well, development of the well, as well as production and distribution of crude oil. Okay, that is that. Now, in PPT, we say an all incidental income, but there's nothing like that in hydrocarbon tax. So we pause it here. So when you look at what I have done here, I have simply summarized what upstream business does, which is number one, exploration of well, exploitation, development of well. We talk of production of oil, and the distribution or disposal of oil. So these are the flow in the upstream sector, right? Now, if that is the case, for the purpose of hydrocarbon tax or PIE rather, PIE introduces dual tax regime. Tax. What do I mean? So this company pay two types of tax. One, they pay hydrocarbon tax. They also pay companies so most of the time this examiner these days has been so lenient to the extent that the examiner will only ask you to compute hydrocarbon tax. But note that these companies pay two types of tax. The first one they pay is the hydrocarbon tax. The second one they pay is the company income tax. Sorry, my voice is getting low. I'm not feeling fine, just struggling. So, if that is the case, let's talk about hydrocarbon tax. Let's talk about hydrocarbon tax. Go with me to page 13 in your notes. For the purpose of hydrocarbon tax, right? So we would have our revenue. From disposal, chargeable. Sorry. Now, there are some things that are not chargeable to tax under hydrocarbon tax. And when you look at what I've written here, I said hydrocarbon tax is applicable to profits derived condensate and liquid natural gas obtained associated gas. Let me talk about something before we move ahead. So what is condensate? What is condensate? Condensate is just like vapor. I usually refer this to when you are cooking rice. You know you'd have covered it, right? When you open your rice, you see that steam that comes out from the rice, and that water that sticks on the surface of the cover of the rice is what we call condensate. Do you understand what I'm saying? So
Yes,
that
sir.
means the process of producing crude oil, there are also condensates that comes along with it. As I'm producing crude oil, I am also producing condensate. I am also producing condensate. Apart from that, as I'm also producing condensate, I'm also producing liquid from non-associated gas. When you cover your pot, you know that you still have some O, Abby. In that your pot, there still be some O's. Now, if you want to get the liquid from that, all you just need to do is to cover that vapor, or that, I can call it vapor, that escapes that well is what we call non-associated gas. Okay? It is not associated. So it is associated gas rather. So as we are producing it, you are also producing associated gas. So these are chargeable to tax according to hydrocarbon tax law. So as I was saying, I said, what do we mean by associated gas? Associated gas is a gas that comes alongside the production of crude oil. It was not intended to be produced. Yes, it was not intended to be produced. The company did not intend to produce that crude, that gas. So, but it comes as a result of production of crude oil and condensate. Then it becomes taxable. Now, what I'm also referring to here, you remember when you did your process costing. In process costing, you will remember that we have what we call normal loss, right? Let's now assume that normal loss you have use for it, then it becomes taxable. For example, during the Abacha regime in Nigeria, sawdust, nobody uses sawdust before. But during the Abacha regime, where there was no kerosene and people will have to cook and eat, people needed to now start going to sawmill to be getting their waste. For them, that waste is normal loss. Whether they like it or not, it is not useful for them again, right? But imagine that they are now selling it because of the fact that people are now demanding for it. Then it becomes a taxable income. Again, I remember my sister told me when they were young in the 80s that Omo, PZ, used to produce Omo then, I think, yeah, that they will go to PZ when those ones are washing their machine. They will wash all the soap away so that they will use it for, maybe they want to produce another set. But people will go there line up on the queue and receive the water from that disposer of that their wash, their machine, they are washing the machine, maybe they want to put it on another one. But that water is their normal loss because there is still element of soap in it. But people go there, take it and use it. Again, flour mills. Most of you know that they have shafts when they are done with their production of their what is it called? Their flour. They have shafts. Those shafts are not needed again. But recently, what we heard is that they began to sell the shafts. So that shaft becomes their associated gas, for example, because it comes as a result of production. It's not as if they intended to produce shafts. That was not their intention. That shaft was supposed to be a waste product, but at the end of the day, they notice that people are demanding for it, so they take advantage of that. So that is that. So what we are trying to say here is that the revenue taxable under, not all this, so under hydrocarbon tax, not all this, include one, revenue from crude oil sales, not it all. Number two, from condensates. Number three, from associated gas. Minus NGL. Now, there could also be other production, okay, but are not subject to tax under hydrocarbon tax. Now, by implication, let's look at that. Now, the following are not subjected to hydrocarbon. Hope you are writing all this thing down. Number one, non-associated gas. The next one, condensates. And natural gas produced from non-associated gas. Condensates and natural gas produced from downstream operation. all this are not subject to tax under hydrocarbon tax. They are not what subject to tax under hydrocarbon tax. Do you have any question? Do you have any question?
Sir, so is there like another bracket of tax that is for revenue from these places?
Yes, sir. So, as we are saying that all these are not taxable under hydrocarbon tax, then where would they be taxed? That is the question you should ask. So,
I have a question.
I'm coming. There are specific to the tax that can be subject to the income that can be subject to tax under hydrocarbon tax, right? But under company income tax, for example, all the income of the company shall be subject to tax. Remember, I told you that this company is accessible to tax on a dual basis. On a dual basis. On a dual basis. On a dual basis. That means they will be subject to tax under company income tax, and they will also be subject to tax under hydrocarbon. Now, it's subject to tax under hydrocarbon tax, right? The only type of income that is subject to tax are this. Meanwhile, when it comes to companies income tax, all this income, all is subject to tax under.
So is that not double taxation on those on those revenue taxable under hydrocarbon tax?
Yes, but that's what the answer is. That's what the answer is.
So can I ask my question?
Yes, right.
My question is, I just want to get the difference between the upstream and downstream. I want to get it clear. And also, all these activities that are taxable under the CIT and hydrocarbon, are they only for upstream activities? Thank you, sir.
All right, thank you. So let's go. What is downstream activity? Don't forget, we talked about upstream. We said upstream activities include exploration, development of well, production of crude, disposal. I did not put drilling. Put drilling somewhere. Drilling. And disposal of the crude oil. Why downstream? Involve distribution, marketing of finished purchases. This find actually therefore we can say refinery is downstream, right? So what Dangote is doing is a downstream activity. Okay? So let's go ahead.
Sorry, please. That what I did not see what you wrote there under the downstream. Is it marketing? It involves the distribution and marketing.
Yes.
All right, thank you.
Now,
Yeah,
having a, yeah,
so
go-
that say now is just distributing and marketing, not that is drilling. What's
no,
it called? In Lagos, I thought it's drilling.
Dangote is not drilling. All they do is to buy crude oil. When they buy crude oil, they process it, they transform it into usable food, and they distribute to the market.
Thank you,
Okay.
sir.
So, having said this, don't forget, I said petroleum companies, upstream now, upstream business, they have two types of tax they will pay. They will pay company income tax. Oh, they will pay depending on the state they are. If they are in PMM, PPL, or they are marginal field, they will pay 15%. If they are in PMM, they will pay 30%. What is a marginal field? A marginal field is a field that was previously being operated by a foreign company and later transferred to a Nigerian company, to a local company to run, right? So in that regard, their tax rate is not as much as that of
Sorry, sir. Sorry, sir. Please, I didn't
PML.
get what you said now.
Please repeat the particular tweet, sir.
You said?
Please, can you come again?
I said the marginal field, right? Is a field that was previously being owned. Ownership of it was a foreign company. Ownership of marginal field was a foreign company. And the ownership is now transferred to a Nigerian company. Okay. Okay. So that is what we mean by a marginal field. So it's not a big field, and they don't produce more. Some of them produce 5,000 per day, 10,000 per day. Okay, they don't produce so much. Okay, so the rate of tax for that should be 50%. So when an examiner gives you a question, the examiner will tell you whether.
Sorry, sir. Please, what's
Don't
PPL and
interrupt.
PML? Like,
You are interrupting me too much.
sorry,
When
sir.
when the examiner gives you question, the examiner will tell you whether the company is a PPL or is a PML company. We have discussed this at the beginning of this class. So you join the class late, that's why we are doing this. When I say PPL is Petroleum Prospecting License. So for this kind of business, we don't have exclusive rights to the assets. So the tax rates is 15%. The next one is petroleum mining lease. They have exclusive rights to the asset. They can sell, dispose the crude oil they see, and they have a maximum period of 20 years to do that. This one has a non-exclusive rights, and they can also dispose what they see there within 10 years. So in this regard, their tax rate is 15%, while this is 30%. So if it is also marginal field, examiner will tell you so that is the tax rate. Examiner will always tell you the rate of tax. Okay, so it's important to note this. So just like I told you, the company will be subject to tax on two bases. The first one is on company income tax, and the second one is on hydrocarbon tax. For the hydrocarbon tax, we must know the nature of the company, whether the company is a PPL licensed or a PML licensed. So that is one way we will determine the tax rates. Now, I told you the revenue that is taxable on hydrocarbon are only these three, while other revenue that the company might have is taxable under company income tax plus the non taxable under hydrocarbon. Now, let's talk about allowable expenses. These are very important. Okay. Before we go to allowable expenses, basis of basis of assessment. Who is this Christopher? Oh, that's my guy. Don't worry. Balikis, how are you?
I'm fine, sir. Thank you.
Okay, let's go ahead. If you guys have any question before we go to basis of assessments, let me know. Basis of assessment. Now, for petroleum company, we are going to be looking at three types of basis of assessment. When a commencement company that just commenced operation, or let's say a new company, right? So, new company. So a new company will be assessed with tax from the day of commencement of sales disposal chargeable end of the year. So when the company commences operation, it's going to be from the day of commencement of the sales of bulk disposal of chargeable oil to the end of the year. Okay, so when they start making sales, then that's when we start the commercial period for them. So the oil company might be in existence and they've not started selling crude. And I see the company is, so I must say the company making as commenced. So when we say the commence is when they make sales of bulk disposal of chargeable oil. The next one, for existing company, an existing company will be assessed to tax from the day from January rather. From January to December of every year. That's for an existing company. Okay. Meanwhile, for a company that is ceasing operation, will be from January of that year to the end of business the end of business life. Okay, so that is that. Now, when you look at what has happened here, you will notice that companies are going to be assessed with tax on actual year basis. You remember when we started this class or this journey together? I told you that an actual year basis period is a base period that runs from January to December of the year, right? So invariably, petroleum companies are assessed to tax on actual year basis. On what? Actual year basis. Okay. Do you have any question for me before we move on to the next one?
Please, I have a question within actual year basis. If they are being subjected to tax on actual year basis, it means it's for that particular year, right, sir? That
Yes,
they want to charge them. That's they will charge them tax for 2025 in 2025.
yes.
So how do they now know the whole expenses they've done? Because they'll still have some expenses they'll be doing towards the tail end of December.
Okay. When we get to procedure for assessment, we see all this. You understand? We see our
Yes, sir.
procedure for that we're going to discuss. In the procedure for assessments, we have two types of assessments petroleum company file.
Yes,
We
sir.
have, hold on. We have the annual returns and the estimated returns. You understand? So for annual returns, within 5 months of the subsequent year, the company must file returns and pay necessary fee or tax due. Okay. Meanwhile, estimated return. Petroleum company must file estimated return within 2 months of the current year. What do I mean? Let's go. Even though I've not gotten to this, but let's talk about it so that I can understand. The first thing I want you to know is that companies in petroleum industry are assessed with tax on actual year basis, right? Be that as it may, right? We need to also understand the procedure of filing returns. In their filing their returns, there are two types of returns that a company operating in oil and gas will file. The first one is to file annual returns. Now, when you are filing annual returns, you are filing annual returns of your prior year in the current year. So, if I finish my financial year with 31st December, so I must file my annual returns for this 31st December within 5 months, which will be May 2026. Are you getting me? Which will be May 2026. Now, again, we're now going to be looking at the contents of annual returns. Sorry, my voice is low. I'm not feeling fine. I'm just struggling to take the class. It's fine. Content of annual returns. Number one, there we talk of audited financial statements. Audited financial statements. Now, the reason why they gave them 5 months is for the company to be able to have concluded their financial statements and have audited financial statement ready for the purpose of assessing them appropriately, right? So audited financial statements, computation of chargeable computation of production allowance, computation of capital, we also talk about evidence tax. We talk of self-assessment, self-assessments, right? Be attested, right? Character or designate of the company. Okay, so that is that. So these are the contents of annual returns, right? So which the company must file when they are submitting their returns to the tax authority, right? So, and within 5 months after the accounting year end, they will submit this. The next one is estimated returns. Estimated returns is based on your budget, right? So an estimated returns will be filed within 2 months of the current tax year. And estimated return will include the following. Now, when I say annual return, so that means my performance in year 2025 will be taxed in year 2025. But when am I submitting the details for company for tax authorities to look at it? I must submit it within 5 months. Annual returns for year 2026, I must estimate my revenue, do my budget, do everything. And based on that, I'll be filing an estimated return on a monthly basis. We are getting there. So, I see. So, what are the content of this return? Number one, estimated profits or estimated income statement next one, computation of estimated chargeable and tax liability, computation of estimated production hours, computation of estimated capital allowance, next one, estimated tax liability, installmental payments. These are the contents of to the sign self-assessments form to signed by the bank or its estimates. Now, I will understand this. Let's go to assessment procedure. Who know we are not supposed to do this now, but we have taken it beyond the normal class for today. No problem. Assessment procedure. Assessment procedure. What are the things you need to do? Number one, compute estimated returns file within 2 months of the current tax. Number two, divide the estimated returns let's call it tax, estimated tangible tax. So divided, limited. Divide the estimated chargeable tax by 12. So imagine after you have calculated your estimated tax, you got 12 million. Divided by 12. You get 1 million for each of the months, right? Now, this estimates must be paid by instrumental basis on a monthly basis, commencing from next or subsequent month. When I say subsequent month, that is commencing from when? March, right? So when I said 5-year estimate within 2 months, that is on or before February. Okay? On or before February. You must file your returns. Divide the estimated returns, divide the estimated chargeable tax by 12. This estimate must be paid by installments on monthly basis. By installments on monthly basis. On monthly basis, commencing from the subsequent months, that is from March. Now, that means when I am done with mine, so if I say I have my estimates, so January estimates will become due. What's the due date? Due date. January estimate will be when? March, thank you. So January estimates. Let's do something. All right, I'll come back. Let's go. So let's say estimates. So January 2025. The due date will be what? March. February 2025. Due date will be what? April 2025. March 2025. Due date will be what?
May.
April 2025. Due date will be what?
June.
May. Let's go to December 2025. Due date will be what? February 2025. Right? 2026. Now, the first thing that you have done as a taxpayer is that you have made an estimate of your tax liability. Now, based on my projection for this year, the tax will be this amount. So the tax authority now says be paying it on instrumental basis. So, and you know that within 2 months, you must submit an estimate for the year. So you have submitted an estimate for the year. The first installment will be due in March. Now, if the first installment is due in March, the subsequent one will be due months after, right? Now, if there is revision to the estimated returns, what happens? then the estimates will be recomputed as follows. I'm going to say total estimates okay, I'm coming. I'll call this one. First one to get this one, I'll just say this first one, I'll just say total estimates whereby number of months. But for this one, now you have now revised your estimates. So how do I calculate my estimate going forward? I would say revised estimates minus total estimates, the one that you have paid, divided by number of months. That's what we will do. So what we are saying here is that there is still what we call final liability, tax liability. This is the difference between the total estimated return and actual returns. This is also called 13th installment. So that is that. Before we leave this class today, since we have discussed this, let's go and do an illustration of it. So that when I come in the next class, it will not be, we will know that we have done this. So go to page 30 in your study pack, page 30. Now we're talking about that. So let's look at an illustration. Illustration 5 on page 33. Illustration 5 on page 33. Illustration 5 on page 33. Who can read it for us, please? Who can read it for us, please?
I read.
Thank you.
Mirror Petroleum Development Company Limited submitted its first estimate to FIRS for 2023 on 27th February 2023 with tax pay.
Submitted its first estimates. When? Right? That
Yes,
means this guy met with the requirement of the law. The requirement says you must submit your estimates within the first 2 months. So the first estimate is how much?
The first estimate is 60
million.
with tax payable of $60
Hold
million.
on. Yeah, tax payable of $60 million. And I said, when you have that, what do? You divide it by 12. Abi? Total estimates divided by the number of months. What do you have? This guy will pay 5 million. So in March, months now, due dates, and amount. On January 2023, the due date will be March 2023. You must pay the installment, right? How much? You will pay $5 million. Have you?
Yes, sir.
So continue.
Okay.
Continue.
In July 2023, it submitted its second
I didn't
estimate.
get the
You didn't get it.
Yes, I didn't get the question, the page. I'm with the material.
Page 33, illustration 5.
So let's go before we go there. So in February 2023, what is the due date? Due date is April 3, 5 million.
So is it the
March,
shared, the one on the WhatsApp?
May 2023, we have 5 million. In April 2023, alpha. So April to June 2023, 5 million, right? Now they now told us in July, in July 2023, they gave them a revised estimate. How much is the estimate that we're given now?
$84 million in July, second estimate.
84 million. What did I tell you about calculating the revised estimates? I say you take the revised estimates, subtract the tax already paid. How much have we paid before that time? 20 million, right?
20 million.
What's the total number of months? 12. How many months have we taken care of before? 4. So I will have some of you just in class. You are asking which material when we're almost running on the class. So that is 64 million divided by 8. What would you have? That is 8 million, right? So we continue again. May 2023. In July, estimate has changed. We will pay 8 million. We'll go again. June 2023. In August, 8 million. July 2023. In September 2023, we pay 8 million. August 2023. In October, we pay 8 million. Now, the examiner told us that in November, the guy submitted a third estimate. November, another estimate was submitted. 90 million was submitted. So, how much have we paid to date? How much is that? How much? $40.
52.
52. Thank you. 52. So I'll subtract 52 divided by 12. How many months is this? 8, Abby?
8 months.
So what do you have? That is 28, 38. What do you have?
9.5.
9.5. So September 2023, November 2023, October 2023, December 2023, 9.5. November 2023, which will be due in January 2024, 9.5. And December 2023, we due in February 2024, will be 9.5. Total 90 million. So you have paid 90 million, right? But you remember, I told you we will have what we call final installment. And I told you, how do you get your final installments? This taxpayer paid all this one based on estimates. Paid all this tax based on what? Estimates. Now, when the actual returns will come, that is 5 months after, we'll have actual returns. Now, in that our actual returns, they now told us that if the final return shows a tax payable of, final return shows a tax payable of how much? 113.65. Determine the tax installment payable. Now, where will the final returns come from? The final return comes as a result of the actual assessments. The company has now been assessed using their financial statements. These actual assessments will come in by May 2025. Now, but before now, the company had paid this. And you remember when we introduced this topic, I told you to get your tax installment, it's going to be final assessment is 113.6 less total installment paid. How much is the installment paid? He has paid 90. So 13th installment or final assessment. How much is that? 23 something.
0.65.
So this is the final assessment based on the audited financial statements. Okay, so that is that. Now, there are penalties where a company fail to pay the instrumental payments. What are the penalties? The company that fails to pay installments, as I went to, will be liable to 10 million. 10 million on the first day they occur, and 2 million for every subsequent days. The failure